Welcome to the Wealthworthy Podcast. I'm Trisha.
Hi, I'm Darian.
Thank you for joining us. This week we figured we'd do a quarterly check-in since we are nearing the end of the second quarter of the year, which means that we're halfway through and we really need to make sure that our financial investments are still in good shape. We're still making moves to hit our goals, short term and long term. And this year has been challenging in many different ways. So just want to be sure that we're comfortable with the different investments that we've done and that it's still an ongoing process, right? So with March being the biggest dip that we've seen in the market in recent years, hopefully if you were auto investing your money, you were able to take advantage of those lower prices to be able to get either more stock, or like if you were investing in other instruments, you were able to obtain good pricing, right? But the gist of it is that the hope is we were involved in the market in some way. So both Darian and I have taken some time to just reflect on what we were doing or not doing during these last couple of months. And one of the things that we did have to revisit is just making sure that our automated transfers were fully set up. We had tried out a few different places, like we had done the M1 Finance and kind of set it to the side. So then we were trying to figure out if we still wanted to continue using it and whether it was going to be the best option for us to continue doing the automated investments, as well as they give you an option in M1 Finance to parse out the percentages that you want to apply to various instruments. So the good thing with them is that they have a good number of the Vanguard ETFs that you can include as a part of your portfolio. But then they also have some of the blue chip stocks and big name stocks that you may be interested in as well. And being able to invest in that without any fees is a great option. So we decided to continue on with that and just make sure that our allocations are set up correctly. And with them, they do have like a referral bonus as well. So we were looking into that as well to see if it was something we wanted to mention, recommend, and use ourselves. Another thing I think we noticed is just trying to ensure that we were investing enough to hit the goals that we wanted. So whether you're trying to save for something that should occur within the next couple of years, or you're looking long term for retirement, you really do want to make sure that things are set up accordingly, right? The more time you have on your side, the more risk you're able to take without feeling like, oh, if things go wrong, I may not have the funding that I thought I would. So if time is on your side, obviously the more you can do now, the better. Were there any things that you felt were important for you to revisit and check in on during this quarter?
Just always make sure that you're paying yourself some form of money. So as long as you're putting something in each account that you have, I think you're making progress.
Yeah, so ideally, if you're saving 10% of your income for investments and emergencies, you just want to be aware of where those funds are being saved and if it's generating the kind of return that you're comfortable with. So obviously with the markets being in this weird state, trying to rebound now, most of the losses have been put back into the market. Like we're seeing a lot of the returns get back to more pre-COVID numbers. It's probably still about a 10% discount on what the prices were before all of this. But you want to be continuously investing. So we don't know when the bottom of the market is ever going to be occurring. And so when you think you've bought at the bottom, you might not have bought at the bottom. So that's why continuous investing is important, because then on average, you come out with the best price that you could have gotten if you're investing regularly without trying to just dump all your money when you think the market is at its lowest. Like, obviously, if it's low and you're like, great, I could buy, and then it's lower and you buy more, right? Like, now you're just in a good position because you didn't miss out on the discount at all. So that's why I'm hoping that everybody has been investing regularly. If you haven't, then now is a good time as well to continue setting things up. We still expect that the market is going to reflect some of these changes that we have seen. So some of it is priced in already, right? We know that there are companies closing stores. We know that there are employees still looking for work. We know that the housing market is likely to be impacted. So all of those things combined may already be reflected in some of the numbers. But once we see people's Q2 results, likely next month, August, right? Like, that's when you might see even more movement, because if people are performing worse than what we're expecting, hopefully that's not the case, right? Because that means the market isn't doing well. But if that's something that happens, then there's possibility for more market corrections. So another thing, I had participated this weekend in an investing kind of course with Journey to Wealth, and it was interesting because their focus was on investing in your retirement. That was a big part of it, like how much and what investments have you chosen for your retirement. And that was a good practical moment, because I think for myself, I had been thinking about retirement investments as long-term, of course, but also as money that you wanted to safeguard in many ways, because you know that you're putting a good amount. If you have a match from your employer, they're putting in a good amount. And so there are a number of like target date funds that a lot of companies will include as options, and those are the majority of the options in there. But those target funds come at a more conservative return rate. So when I looked at the options that I had with my job, there was definitely those target funds, and the rates were more in the range of 6 to 9%. And while that's good, if it's not beating the rate that we see in the overall market, the S&P 500 or the total market, then is something to reevaluate. So that was one of the big things that I took away from that course that I took. And so I would implore you all to revisit your investments as well and see what kinds of returns you're receiving on those funds. And of course, if you're not already maxing out your retirement, your 401k retirement funds, then you should if your company offers a match. So if they're matching 5%, be sure that you're at least putting in that 5%. But that was one thing that could save you tons of time and make you tons of money if you are weary of the percentage that you're receiving, because the total market was closer to 12-13%, and if you were only earning 6%, then that's a huge difference down the line for you. In that same vein, we've talked about being sure that you've invested in your HSA, so it's a good time to be sure that you're also maxing that out if possible, and being careful that your HSA is being invested in funds. You have to elect for your HSA to be invested in a fund. Most of the time they'll just put it into a cash settlement account, and you'll earn small interest on it. And I looked at the rates on that, and it was closer to 0.6%, where if it's in a fund, you could at least be earning if not what the market is offering, at least a 6% kind of return on the money that you're including in your HSA. The good thing with HSAs are just that it's usually pre-tax money. If you spend it on health, any kind of health care, then it's tax-free for your spending, and then you are able to invest it. So all of the earnings that you get from those investments are going to be tax-free as well. So if you can max that out, then that's a good option as well. So between doing your 401k match and doing an HSA, those two are usually through employers. So if it's an option for you, then definitely be sure that those are two areas that you're maxing out and getting the full benefit from. One other area that we've talked a lot about when we discuss investments is your Roth IRA, and that one has income restrictions. I believe for individuals it's about $135,000 this year. So if you make lower than 135, then you are eligible to participate in a Roth IRA, and that's another good option for you to invest your money tax-free. So you pay taxes on the funds that come out of your regular income, put it into this Roth IRA, and then any interest that accrues over time through your investments all grows tax-free. So really, those are three of the best tax advantaged. Well, 401k isn't necessarily tax advantage unless it's a Roth, right? Those have different situations. But the point being that those are three areas: Roth IRA, HSA, and 401k are three areas where you really want to take advantage of both the tax benefits and the employer-related benefits that may come your way. So good time to just check in to be sure that you're maxing it out. And if you aren't able to max it out, right, like how much can you push out of your checks to be sure that you can take advantage of that? If you're not in this space of being able to take advantage of those opportunities, we really just want you to be sure that you're looking at any options that you have to save your money, minimize your debt, and find these options to invest. Like the Roth IRA, for example, isn't necessarily through an employer. You can open one up independently. Like Vanguard has IRAs. Most of the brokerage firms have IRA options. So you can open that up on your own if you have not already. And that's a great way to begin planning for retirement, even if you don't have access to some of the other options. But I can't say or emphasize enough that you can't go into your financial goals with a huge debt load and expect to see miracles happen, right? You really do have to begin to curb your spending, figure out what's most important to you, and spend in the areas that make the most sense for what you have going on. So whatever you can do during this time, many of us have been stuck inside, and hopefully that's translated into some kind of savings, right? But whatever the case, we do need to be sure that at least if we can look at how to minimize what we're spending and determining if we have too much money flowing out. So those are probably some of the most important areas that I would want you guys to check in on for your own investments. And those are areas that we've been looking at for ourselves as well. Anything else that comes to mind for you, Darian?
Save.
Yeah, I think that's a big piece of it, right? You don't want to just have your money sitting in a non-interest bearing account, but at least if you're in the habit of saving money, you can figure out how to divvy that up. You can decide if you want to have it automatically transferred into investing accounts, right? We've been using Fundrise for real estate investments. We've been using Robinhood for individual stocks, and now now. They've opened up their fractional share options, so you can buy fractional shares there. We talked today about using M1 Finance. You can use Vanguard, Fidelity, Schwab, TD Ameritrade. They seem to be combining, but you can use any of those options to figure out how to divvy up your funds into these various accounts that will help you to achieve your financial goals. I think one of the other things that has probably become a part of your decision making is around how much you have available for donations and any other family related expenses that are important to you. And so that should be factored into your expenses, right? Like those shouldn't necessarily be funds that you're taking from the amounts that you're looking to save for retirement or for your goals. So just thinking about how are you paying yourself? Are you taking 10% of your income before any other expenses are incurred or come up, right? Like, do you have a separate emergency fund from the amounts that you're looking to invest for all these goals? If you don't, then this would be the time to begin thinking about that. Is your money in banks that aren't offering at least 1%? Like last quarter, we were still in the space where companies or regular digital banks were still offering close to 2% or 2%. And now we're in a space where a lot of them are offering closer to 1%, right? Which isn't a huge growth on your money at all. But if you're in a major bank where they're still offering you 0.001%, right? Like then at least if your emergency fund is earning that 1%, then you can feel comfortable that for the short term, you have the security of your money being available and you're still earning something on your money, even though you can easily access it. So we just wanted to kind of use this time to be sure that you're focused on where you are. We're halfway through the year and there's still time for you to ensure that the rest of your year is still productive and fruitful when it comes to your financial goals and investments. I know that this is a challenging time where looking for jobs and taking advantage of the unemployment benefits that are being offered is likely a part of many people's day-to-day, but you still don't want to get out of the mindset of taking advantage of these investment opportunities and trying to still attain your goals, right? Even though things happen, you don't want to stray too far from what you have planned and what you're trying to achieve. So just be mindful of how these last few months have impacted you. If you're off track of what the plan was, then figure out how you can begin getting back on track. And we'll check back in again next time. Thank you for joining us this week. Bye.